Back, class. This is a Chapter 7 video for Accounts Receivable, and in this video I'm going to cover some of the material that we've already talked about in class, but in a way that you can come back to it and look at it over and over if you need to, or refer to it in the future. So, starting with what accounts receivable are, if we're a business and we're selling to our customers, typically a lot of customers are going to come in and they're going to purchase something on credit. So we will, if we have an internalized system where we keep record of the accounts that we let customers charge for, we'll have accounts receivable that we're going to identify for each of those customers. So with that in mind, this first diagram here in 7.2 gives a good illustration of what that looks like. You have a general ledger account for accounts receivable that's a control account, and then you have a subsidiary ledger with individual accounts to show the amounts that they buy on credit and the payments that they make. So if we look at how these transactions occur, what we're going to do is we're going to enter a journal entry for when they actually make the purchase, but then we'll record that purchase in the ledger for the accounts receivable, but also in the subsidiary ledger for their individual account. We'll need that because at some point we're going to issue a bill or a statement to the customer and expect them to pay their account. So here's a couple of examples. On July 1st, a customer comes in and charges on their account. Comp Store buys $950 worth of items on credit, so we debit accounts receivable Comp Store and credit sales. We also have another customer come in and pay on their account, which is RDA Electronics, so we debit cash and credit the receivable there. And you'll see that transaction here. So the actual payment will look a lot like the actual purchase. We're going to record it in both places. So we'll do the journal entry like we did above. Then we'll post into the general ledger here the $950 debit for accounts receivable and move over here to Comp Store's subsidiary ledger and post it in here so that we have a running balance for Comp Store. Likewise, we'll show the payment by RDA here and then also in the subsidiary ledger so that we actually have an up-to-date current balance on each of the customer's accounts. If we are selling items on credit and we have a store-issued credit card, it'll work a lot like the accounts receivable that we just looked at. The difference is with this, we're going to issue a credit card. We're going to recognize the sale of items on accounts receivable because we haven't collected the balance on the card yet, and we'll record the sales, but then we're going to also recognize the interest that was earned on the store credit card sale. So if there's somebody who comes in and purchases items and they let the balance go beyond the first month, there's going to be some interest charges. If we do a bank card sale, it's not going to be any different than dealing with cash, with the exception that the bank card company is going to charge us a percentage of the sale. So in this case, there's a $100 sale. The credit card company is charging 4% as an expense. What we're going to do is we're going to debit cash for the difference between the fee that the bank card company charges and the sale itself. So we record the sale at full price and then show the $4 as an expense of making the sale, and we're going to call it credit card expense. So those are the main ways we're going to record transactions when we sell items on account. And this example here in Need to Know 7.1 goes through those kinds of transactions as examples. We have a sale on January 2nd on a bank credit card where there's a 5% fee. So we have the sale of $1,000. The 5% is going to be $50, and we'll have a difference of $950. That's the cash we received. When we do this and we're recording our inventory based on perpetual system, we're going to debit cost of goods sold and credit merchandise inventory. for the actual cost of that merchandise. So the merchandise sold for $1,000, but it actually cost us $600. So we're showing that here. Likewise, if we sell here a credit card sale again, we show the credit card expense, the total sale, and the net cash that we're going to get. We also debit cost of goods sold and credit merchandise inventory based on the cost for those items. The thing with interest earned on store credit cards, we're going to record the interest as receivable in accounts receivable every month as we go. So if there's an outstanding balance, we're going to recalculate the interest that's receivable. Now, when we write off bad debts because we can't collect them, those are the accounts receivables where somebody doesn't pay. There are two methods of doing it. One is doing a direct write-off method, and there are companies that do this. It is a fine method to apply. It doesn't match things up quite as well as the allowance method. So the allowance method is actually the preferred method for accounting, but it's okay if a business wants to use this direct write-off approach. So if they do, they don't actually set up an allowance ahead of time. They don't really calculate what they expect to have in uncollectible accounts, but what they do is that they actually write it off. When they write off a customer's account, they just put it in bad debt expense. So directly to bad debt expense, $520 for the customer, J. Kent, who didn't pay their account. However, if the customer decides at some point they want to clear their name, they want to clear up the account, and they come in and they say, you know, really, I overlooked this. I want to make this payment in full. We cannot actually process the payment until we restore this account to what its original status was. So to do that, we're going to debit the accounts receivable for J. Kent for the $520 that we wrote off earlier and credit the bad debt expense for that amount. And then we can record the payment. So we debit cash and credit the accounts receivable. So when we go to the direct write-off method, the advantages of it are really it's quite simple to use. It's not really time consuming. You just basically do it when you need to. The disadvantage is that there may be some overstatement in receivables and the income that you're reporting, and that bad debts might not really be matched well with the sales that are related to those bad debts. So if you are using an allowance method, you're going to recognize the expense of the bad debt in the year that you set up the allowance account. Where if you do the direct write-off, it'll be possible for you to make the sale in 1 year and then write off the account in the next, and that would not leave the income matched with the expense. So if you're looking at the direct write-off method, here's a good example. Basically some transactions you can look at to see how they do it. They're just debiting bad debt expense and then crediting the accounts receivable. And then apparently ZZZ company had a second thought and they wanted to pay their bill. So we reverse it. We debit the receivable, credit the bad debt expense, and then we debit cash and credit the receivable when we receive the payment. The allowance method is a little more complicated, but it's, again, much more accurate in the way that it reports or matches the bad debt expense with the income that we benefit from with the credit sales. So with the allowance method, we're going to compute an allowance up front and say this is what we want our allowance to be. We expect that we're going to write off this much in bad debts. So we record based on whatever calculations we make, bad debt expense for the year of $1,500 and credit the allowance account for what we expect to write off. And so here's what we have. We have the accounts receivable amount of $20,000 that the company has and an allowance credit of $1,500. Now, when we report this on our financial statement in the assets section of the balance sheet, we're going to show the accounts receivable balance of 20,000. That's right here. And then we're going to net out the allowance amount, because we are going to show these receivables at their net realizable value. And because we expect to write off $1,500, we are going to record these at the lower amount of $18,500. We're going to show that we're actually anticipating collecting $18,500 as opposed to the full $20,000. Sometimes it may not be reported separately. It may be reported on the same line. Here's an example of that, where it just says the accounts receivable are net of the doubtful accounts, $1,500 for the allowance of doubtful accounts, and it's $18,500. Now, when we write off a bad debt with the allowance method, it's no different than what we would expect, but we're not going to debit to bad debt expense. Instead, we're going to debit it to the allowance account, because that's where we put this reserve to anticipate these write-offs. So in the case where we write off J. Kent's account under the allowance method, we're going to debit it not to bad debt expense. We've already debited bad debt expense for the year, but this will go into the allowance account as a debit to reduce that balance. The receivable will be credited. And here's what will happen with both of the accounts. So with the accounts receivable, we're going to reduce it by the $520, because we're crediting the accounts receivable for Kent here. And the allowance account, we're reducing it by $520 because we're debiting it here for the write-off. What you have using the write-off method is a very consistent method of reporting, because you'll notice that the actual realizable value of accounts receivable is the same before the write-off and after the write-off. It does change the balances, but it's going to change the balances by the same amount for each account, and therefore the difference between the two amounts will remain the same. So now, after the write-off, our accounts receivable is $19,480, and the allowance is $980. When we actually make an adjustment to an account, we collect it later, and we want to reinstate the account and then collect the money, we're going to have to do it like this. It's going to be a lot like the direct write-off method. We're going to debit the accounts receivable for J. Kent to re-establish that account at $520, and credit the allowance for doubtful accounts for $520. Then when Kent pays us, we're going to debit the cash and credit the account. Very simple way of doing that. And then here's an example under the allowance method, some transactions that are going to take place. Okay, and then when we want to calculate the allowance at the beginning of the year or at the end of the year, whichever period, wherever we're calculating the allowance, typically this is done at when we're looking at the beginning of the year or something of that nature. But here they're going to say, well, we're going to calculate it based on a percentage of sales. This makes sense if you know about how much of the credit sales you have that are going to not be paid. In this case, they say we have $400,000 in credit sales. We anticipate that 0.006 or roughly 0.6% will not pay the bill. So we're going to take that, multiply it, and we get an amount of $2,400. So we have about 0.6% of 400,000, which is 2,400. That's the allowance amount that we're going to establish. So we debit bad debt expense and credit the allowance account at the beginning of the year. Now keep in mind, when we're calculating it based on percent of sales, we do not care what is actually in the allowance account when we calculate it. It does not matter. We are not saying this is what the total allowance account should be. What we're saying is, based on these sales, only on these sales, we're anticipating this to be the write-off amount, the allowance amount. So we're just adding that to whatever's already there in the allowance account. We're not looking at the allowance account balance to consider what this amount should be. We don't really care at this point with a percentage of sales. However, that does change with a percent of receivables method. With a percent of receivables method, we're looking at it differently. Instead of looking at just the sales and the income, we're looking at the whole of accounts receivable, and we're going to say that a certain percentage of them are going to not be collected. So when we do that, we're going to say that what we're calculating is the new balance that should be in the allowance account. So what we're actually saying here, when we look at this, we're saying we have a percentage of our accounts receivables that we're not going to collect. And so we have 50,000 in accounts receivable. This is all receivables and may include some from prior periods. But we're going to say 5% of those are not going to be collected. So we take the 5% of 50,000 and we arrive at a $2,500 balance. Because we're basing it on entire receivables, what we're saying is this is what we calculate the total allowance should be. This is what the entire allowance account should have as a balance when we get done. Now, in this case, in this example, in Exhibit 7.7, they have a balance of $2,200, but they've written off $2,000 worth of accounts. So we have a balance of $200 as a credit. In order for us to get back to the $2,500 amount that we believe we should have, we need to make an adjustment here of less than the $2,500, so we arrive at $2,500 for the balance. So we'll take the $200 and subtract it from the $2,500 to get the $2,300 credit adjustment. And this is where we do the adjustment. We debit bad debt expense and credit allowance account, and that will bring us up to the $2,500 amount. Now, if we do an aging of receivables, we're going to be thinking about it in the same way. An aging of receivables method is much more accurate because it breaks down all receivables into components based on age. And typically what you're going to find in accounts receivable is that the newer the receivable is, the more likely it is it's going to be paid. So you have items that are not due yet. You have items that are 1 to 30 days past due, 3160, 6190, and over 90. Look at the percentages for each of the categories. You'll see a 2% for not due yet, a 5% for 1 to 30 days. We're thinking with these two items here, we're going to collect the vast majority of these accounts. There may be some small percentage that we don't collect, but most of it we will. Now, when we get past 31 days, you'll notice we have a jump in the percentage here. We go from 5 to 10%. That's still not a huge percentage, but it has doubled. And so we're going to calculate that for these receivables. When we go to 61 to 90, now we're getting into the territory where we're going to see a big jump in the amount we anticipate not collecting. So here we're going to say 25% we won't collect. And then if we go over 90 days past due, that's where we begin to say we probably aren't going to collect these. And so we have a much, much higher percentage that we don't anticipate to collect. So 40% here. You add all of these together to get the total estimated uncollectible accounts of 2270. This is what you're saying the allowance for doubtful accounts should be. So when we look at it, we're going to say, okay, we have a $200, based on this example we've been working with, we have a $200 credit in the account. We're going to compare that to the calculated estimated balance we think should be there. And we have 2270 credit we calculated. In order to get to the 2270 with the $200 credit that's already there, we only have to do an adjustment for 2070 that will bring the allowance account balance to a 2270 credit amount. So here's the journal entry to record the allowance for doubtful accounts for the year. We have 2070 debit to bad debt expense and a credit for the allowance account. Now, what happens if the allowance account is actually a debit balance? What that means is we've written off more than we anticipated. And so we've crossed over from having a credit balance in the accounts receivable to a debt, or not receivable, but to the allowance account, to a debit balance in the allowance account. So what we're actually doing now, instead of subtracting, we're saying how much more do we have to add to the account to bring it back to the 2270 that we credit that we anticipated. And the only way we're going to do that is we're going to add the 500 to the 2270. We're adding it because we have to essentially write off this $500 debit amount that's in the account. We've already written it off, but we basically need to bring that into this calculation so that we have the right balance. So now instead of 2070 that we were writing off previously, with a debit balance of 500, we're going to have 2770 because we've added the 500 to the 2270. We're going to debit bad debt expense and credit the allowance for 2770, and that will bring us back to the correct balance in the allowance account. Now this is a good mapping of the two methods. And if you look, the estimation based on income is an income statement focus and based on a percentage of sales. But if you look at the balance sheet side of things, you're doing the percent of receivables or the aging of receivables because you're looking at the entire receivables and estimating what their net value should be based on age. Here's a good example of calculating the allowances, or what the allowance account should be, and the adjustment that's needed to do that. Now, one last area we need to talk about are notes receivable. And this happens sometimes in business if we have an accounts receivable customer and they can't make their payment. They may want to change part of their account into a note. And we will do that because we're going to collect interest on the note. So if you look, this is an example of a note. It has some key elements on it that's going to identify what we need to know about it. It'll have the balance, the principal amount, the date of the note when we actually make the note. It'll have the term for the note, 90 days. And then there's this promise to pay $1,000 plus interest at an annual rate of 12% from the customer. So we're going to have to compute a couple of things. Number one, we need to know when this maturity date is going to be exactly. If it says 90 days and we make the note on July the 10th, we need to do a calculation to find out exactly what day that's going to mature. So we take the 31 days that are in July, we subtract out the date that we made the note. That means we have 21 days in July. We're going to add to that the 31 days that are in August and the 30 days that are in September. Now, when we add these three numbers up, we get 82 days. So that means that when we cross into October, we only need 8 more days to get to 90. So we're going to say that the maturity date should be October the 8th because it's due in 90 days. When we put the 8 in here and add those up, we get the 90 days for the note. Now, when you calculate interest on a note, you're going to take the principal of the note times the annual interest rate times the time, the length of time the note is in force, expressed as a fraction of the year. The calculation will look like this for the note that we looked at above. When we looked at the note up above, it had a $1,000 face value, 12% interest, and it was good for 90 days. So we're going to do this computation then to find out how much interest we have. Now notice we take 90 days over 360. This is what they call the banker's rule, and basically instead of calculating everything on 365 days, we're going to calculate it on 360 because it makes the computation so much easier when we're actually splitting the year out like this. So when you have 90 over 360, you're basically looking at 0.25 or 25% of the year, a quarter. So you're going to take $1,000 times 12% interest times 0.25, and you get $30 interest that's due when the note is due. Now, when we record the note, if we're just doing it based on sales, we're going to do it like we do in accounts receivable. We'll have notes receivable and then the sale, and we'll identify the amount. Now, sometimes we'll accept a note from an overdue client or customer, like I mentioned earlier, simply because they don't have the money and we are interested. We will offer them the opportunity to extend it if we have the opportunity to earn interest. So to do that, what we're going to show here is that TechCon didn't have the money to pay the full bill that they had of $800 plus interest. Or no, $832. I'm sorry, not 800 plus interest, $832. So what they're going to do is they're going to pay the 232 that they can and give us a note for the balance of $600 for the remainder of the time. So they pay the cash. They give us this $600 note that's bearing interest, and we credit the entire balance in their accounts receivable. So in essence, what we're doing is our customer, Jake Cook, we're TechCom. I'm sorry, not TechCom's not our customer, but the customer Cook has come in and said, I can't pay the 832, but I can do the 232 and give you a note for interest. You say, okay, we'll do that. And this is how we establish the note and close out the accounts receivable. Now, when a note's honored, that means it's paid at the due date. So we get up to the due date and Cook pays the note the way that they should. So what we're going to collect from Cook is the amount of the note of $600 of principal plus the interest, which is calculated here. 600 times 15% times 60 over 360. That will give us $15. So we show the note receivable, we show the interest revenue of $15, and we debit the cash for the total. Now, if the note gets to that date and Cook doesn't show up, doesn't pay, we're going to consider the note dishonored. So what we will do is we're going to close out the note and we're going to recognize the interest revenue that we've earned on that note, and we're going to put it back into the accounts receivable. Now, at this point, the the accounts receivable, even though it's not in the note receivable, is going to continue to earn interest based on the note that the customer signed. So if they pay later, they're going to pay additional interest. Now, there are times when we get to the end of a period and we have some notes receivable outstanding, we'll need to recognize that perhaps a note crosses the end of the year. So we're going to calculate the interest receivable before the note's paid. So we're crossing the end of the year in December. We have a note that somebody's going to pay us. It's a $3,000 60-day 12% note. That means that in December they signed this, December 16th. That means the note won't be due until after the first of the year. So on December 31st, we're actually going to compute the interest on the note earned up to December 31st, and we're going to record that as interest revenue, but we're going to put the $15 in interest receivable. Then when the customer actually pays the note when it's due, February 14th, they're going to debit the cash for the amount of the note plus interest. The note itself is $3,000. The entire interest is $60, but we've already booked $15 as interest receivable and interest revenue. So we only need to book interest revenue of $45 at the first of the year after the note is collected. So the total payment of $3,060 includes the interest revenue for January and February and the interest receivable from December of the prior year, and then of course the face value of the note. So that's calculating the note and how we handle it as a receivable. Here in this need to know 7-5, you can see some of the transactions that they're showing you. And these transactions are going to be very similar to what we've already talked about. They're showing the note receivable that's being received when something is sold. They're calculating interest receivable through the end of the year, and they're going to calculate interest revenue. So then after the first of the year, the note is paid. We have the accounts receivable of $14.42. We have interest revenue of $35. We have interest receivable of $7, and we have the notes receivable. This is not paid. This is dishonored. Then they come in and they pay the note, or actually the accounts receivable. So when they come in and pay, we're going to show the full amount of the payment, $1,442, the interest revenue that we've earned in the new year, plus the interest receivable we calculated in December. That's if they pay it. Now, if we're writing it off, here's how we would do it. We've reversed it out of the note into the accounts receivable. But assuming after letter B we have to write it off, we're going to debit the allowance account and credit the accounts receivable for that customer. So one other thing with receivables, you can sell receivables. This is done periodically, and it's called factoring. What normally happens, the buyer who is the factor will offer us a certain amount of cash for our receivables, and that will be net of a factoring fee that they're keeping for themselves. It's essentially their fee for doing this. So, and basically it's going to be their profit, their income on these receivables. So they offer us for our $20,000 in receivables, $19,200 cash. We're going to record $800 of that as a factoring fee expense. We're not going to receive $800. We're going to get $19,200 instead of $20,000. But we have to write the whole $20,000 off because we've sold it and it's closed to us. So we debit the cash, debit the factoring fee expense, and then the total amount gets credited to accounts receivable. You can pledge accounts receivable. Then you can borrow money from a bank and pledge the receivables as collateral. If you do that, the transaction would look like this. You debit cash and credit the notes receivable, and have a note here that you're pledging receivables. You would also disclose the pledged receivables in the financial statement footnotes. So that's really it for Chapter 7. I hope that helps, and I'll be making a video for Chapter 8 soon as well, so stay tuned for that. But anyway, I will put this up, and good luck to you with this.